Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Crustman, here with Ben Brayshaw, Dan Mickelin. How are you guys doing on this week before Christmas?
You know, I haven't seen any of my presents on my desk yet from you guys. So I'm just going to tell you, Seth, Dan, that, my week's not looking so bright right now.
Supply chain issues, Ben. They're coming. It's all supply chain.
Supply chain. Yeah, I bet it's a supply chain.
They're blowing up the tankers in the Gulf. Don't you hear about that? Yeah.
I'm not sure what to say there. Is there a car with a bow out in the parking lot waiting for you? Was it a new Lexus or something? Was that what I got you? I forget.
I haven't seen either of those, but if they're there, you would be my new favorite partner.
No. It was a $20 gift card to Starbucks. That's what I got you. I'm surprised that hasn't shown up on your desk yet.
No, that hasn't shown up there either, there, Seth. But you're both forgiven. You're forgiven, man. Listen, this is a season of giving and grace, and all those things. I mean, but I'll remember.
Yeah, I'm hoping that people out there's experiences this Christmas is a little better than Ben's. I know mine has been so far, so I'll just go with that. And today we do have a really great show lined up for you. We have in store for you how to some techniques and tricks of what you want to be paying attention to, or what you can be doing for yourself and your portfolio in 2024. Fantastic show to line. It's going to be a two-part show for you guys, just to give you a heads up. There's just so much to cover in this. So how do we navigate the financial terrain of 2024? What are the insights? What are the strategies? We're going to bake this in for a couple shows because we know that's what you like out there, our Money on Tap listeners. You love to hear about the market. You want to hear about how to be better inside of your portfolio. And what are the issues that we can address for you here on Money on Tap?
Seth, it is going to be two shows, but it's going to be a lot of really good information. I think a lot of people are just trying to figure out, hey, there's a lot going on in the stock market right now. There's been this massive rally. You're reading news articles that go one direction or another. Everyone's scared, really, because you're like, I'm either going to miss out or I'm going to get hammered. And that's really why people get scared. And I'm excited that we're going to be able to be kind of a concise distribution of information to really help people look at some core elements to kind of redirect their investment portfolio, make sure that they have a kind of a sound foundation, a sound footing in some of that. And I think that's going to be important. I think it's also going to bring some awareness to some investment categories that maybe people aren't really considering in their everyday investment piece. And I think that's going to really bring a lot of ability for people to feel empowered. And I think that's what I like about what we do here today.
Yeah, the world of investments is ever expanding. I mean, it just seems to get more and more crowded with options and different ways that you can try and grow your portfolio. But we're going to help try and limit that field a little bit and kind of point you at the things that we think are going to be most important for next year.
Which also relevant to me getting my Christmas gift, guys. So at some point in time, if it's not this year, you got a whole 12 months to plan.
We'll work on that.
All right.
With that, it is time for Money in the News. ENC's annual Christmas price index tracks the price of gifts listed in the 12 days of Christmas. Thank you, Hustle, for getting this over to us and alerting us of how we can understand better how the price or the cost of inflation has affected our 12 days of Christmas that we've been giving to Ben. It's reliably the most charming way to track how much inflation blows. This year, the total cost of all items from the song would be $202,000. And just in case you're not familiar with what we're referencing here, it's a 12 Days of Christmas song. And if you were to take each one of those items and shell out and buy those for been, or your loved one, what would the total cost be? Well, in comparison, that's this year $202,000 from 2019, a cumulative of $170,000. So, little tidbit in here: if you want to surprise your loved ones with a deeply impractical and painfully expensive, all-around terrible gift, 7 swans of swimming will cost you $13,000 on its own. Have you note that there really was relatively little inflation on that $13,000 from the last couple of years. So that's a nice way to maybe just bank that $13,000 if you're wondering what to do for your loved ones.
Yeah, everyone could use a couple extra swans around Christmas. That's for sure.
I'm wondering if it was the swans or the pool. I'm assuming if that's an in-ground pool that they're putting in there for you, or a pond.
It would have to be. It can't go above ground with swans, right? Next up, the 4-day work week was a long shot, but the UAW isn't giving up. This is coming to us from Chris Isidore over at CNN. And this article's interesting to me because I've long been a proponent of the 4-day work week. I just always thought it was, kind of comical to even consider. It's just hard to wrap my head around such a change and how that would impact all of us, around the globe here, really. But it's actually been something that the auto union workers have been pushing for like 70 years. I didn't realize that this goes back quite so far. But they're looking to, again, negotiate a 32-hour, 4-day work week with no reduction in pay.
This article was interesting for a couple reasons. One is the auto workers basically said, "There's no way we can do this. This would kill us." That only 7 to 8% of a car is the actual cost of labor. I mean, the article points that out, and that was interesting. But there was a whole testing. There's a whole group of companies that offered this out there. And I think it was like over 900 workers. 27 companies had offered to do this 32-hour work week, no change in pay, 4 days, get the job done concept. So it's potentially working more than 32, but you get 4 days. Not one company changed their standard after re-interviewed, which I thought was interesting. But I think, it really depends on the kind of business or job you're in. If you have a company that the labor can just be continuously done and, and so forth, like they were thinking the auto workers would be perfect for that, it really doesn't work as well. And for whatever reason, they were just like, our statistics say this isn't really good for us. Curious. I don't know if it's a physical labor issue. I don't, like just people getting tired and getting slower over time, and, are you wearing people out? I don't know. But I don't understand this. We have a world that runs on 7 days a week, 365 days. There has to be almost somebody everywhere in every gas station, Home Depot, Target, Walmart, there always has to be somebody there. So I'm just trying to figure out, how does this work? How does it facilitate? I mean, I think the labor shortage and trying to cover those main core hours instantly creates a problem for every Friday or every Monday, or, if you start shifting people. And people say, well, Tuesday to Friday or Monday to Thursday. I just don't think this is a healthy piece, because we all expect every company to be open at least Monday through Friday, 8 or 9 to 5 or 6. Right? I mean,
there's clearly staffing shortages everywhere as it is. So where would you find the extra bodies to fill those gaps? It's just, I think, just the tip of the iceberg issue. I think there's lots of issues related to this, this proposal here, but I just can't fathom it ever really truly happening. But what was interesting in the article is a kind of renowned economist from back in the 1930s, John Maynard Keynes. He predicted that by the 1980s. That we would all be working a 15-hour work week, which is absolutely incredible. I mean, that's not even working. You do 15 hours a week on vacation.
Probably figured we were going to be communists by then too, but maybe we
are. It's answering emails for the week. That's what that feels like.
It's emails for the week.
Oh my gosh! Well, I can tell you what, I love I love to apply this to pretty much ourselves or anybody else, where if we were to go down to that 32-hour week, and what would that do? That would increase the wages by about 25%, is what they're saying here. And I love that kind of math. I mean, let's see how that works. And I don't know. Maybe the auto industry just completely revolutionizes itself, or maybe they're the next hostess and the union completely destroys an entire industry.
Well, it's service industry is definitely the one that's going to be impacted the most on something like that change. That's just potential massive issue. I mean, if anything, service industry needs more people working more hours than ever before.
Yeah, that's a fact. Next up, we have IRS zaps nearly $1 billion in penalties for taxpayers. This is coming to us from Fox. Ashley Ebling is the author here. And what the IRS is doing here, for people who have overdue unpaid taxes from 2020 and 2021, they're giving you an opportunity to pay up those debts with no penalty as long as you get it done by, I think it's April of next year. So April 1 of 2024 is what the due date will be here. And that's for anybody who has back due taxes under $100,000 for 2020 or 2021, which is it's an interesting give back here. So, a little Christmas gift from the IRS potentially if you find yourself in that category. They can't legally waive the interest, which I thought was interesting on this, that, interest on tax debt is written into law and can't be waived, but the penalties can be.
Right.
So you can find yourself at some degree of savings here if you're in a position to get paid up.
Yeah, I think that that is a good and important point to make, is that interest cannot be waived, but penalties can. So if you're in this situation, you're dealing with some debt and you're trying to address this, you haven't had a payment program for at least 3 years too. They're very, very flexible on the penalty piece. And that's something to engage in and try to really work with. Well, a lot of people think that the interest is the one that's waivable. So as you start asking the wrong question, you get the answer you don't want to hear. So you have to know what to ask for, and I think that's important. There's been a lot of relief and a lot of debt considerations made over the last number of years with the COVID, and all this stuff's kind of coming to an end. And we're starting to see that. And with 87,000 new IRS agents and the automated system running again saying you owe money, be sure that you will hear from them. Something not to take lightly, but to know how to address it is important. I would encourage people that if you owe $20,000 or $30,000 or more to the IRS, probably getting some professional help would be a wise decision. But I would encourage you to steer clear of the we're going to save you tens of thousands of dollars company things. I would talk to your CPA. I would talk to a legitimate CPA, find out what they recommend, find out who they might say to use, see if they can handle this for you, because a lot of these debt companies are really just bogus. You end up paying them the money. They hold the IRS. I mean, it just can get really bad really quick, and then all of a sudden some of them have, I heard, disappear, and you could be really poorly treated. So work with your professional on something like that.
Yeah, speaking of working with professionals, if you're on our newsletter or our mailing list here at Money on Tap and Brayshaw Financial Group, you're going to be receiving from us an email basically introducing you to the people on the Brayshaw Financial tax team that help our clients, and the people that we know and care about. We refer to them to help them out with their taxes during this season. They're just a huge benefit to us here at Brayshaw Financial Group when we're working through our clients and their needs. Sometimes they're just within a scope that they currently don't have that help in. We're able to rely on this team here at Brayshaw Financial Group to support you, your vision, your goals, and some of the needs that you have in this realm of taxes, which everybody does get into the weeds here, and it's great to be able to have them here. So also just be looking forward to those notifications going out to you in our email here in the next couple of weeks.
Seth, I'm glad you brought that up. I wasn't even thinking about that, and I just a lot of our clients, working with us and working with the CPAs and the tax professionals we have here makes it a really very healthy symbiotic relationship to really make sure you're maximizing that as best as possible. The information they need is at our fingertips, and it's usually a really great opportunity. Plus, some of the tax return stuff that people do here is significantly less expensive, which is actually fairly nice for a lot of our older clients who don't even really want to have to file taxes anymore. So that's a nice piece of it.
You're listening to Money on Tap. And when we come back, we're going to get into navigating the financial terrain of 2024, the insights and the strategies that we're looking towards for you. Also, want to thank you as podcast subscribers. Thank you so much for doing that and subscribing. And also, if you just wanted to help us here at Money on Tap, if you could just drop a note into that review section, or give us a rating, some stars, whatever on your podcast platform that you're using, whatever's available there. All that stuff really helps us out to just build awareness and bring Money on Tap to more people. Thanks again for your support. We appreciate you. Again, we'll be right back with more Money on Tap.
Hey everyone, Dan Mickelon here with Brayshaw Financial. Looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100, enjoy a user-friendly platform with a diverse range of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Hey, we are into the final stretch of 2023, which gives us, an opportunity to reflect, right? That's maybe what you've got right now is a fire going, and you're just grateful for what 2023 has brought you this last year. Hopefully there's been a lot of health, a lot of memories. You're making some memories now. And it also gives us an opportunity to take a look forward and see, hey, what are we doing right now? What do we think is going to be happening in this next season? And how are we prepared for it? And that's what today's show is really about for you, is taking a look in 2024. Now, we do have quite a bit of data to cover. So there's some seasonality to what we're going to be talking about today. Given what we've had recently in this last year's market, what's been precedented prior to this market, what has happened in market cycles that have similarities to where we're at today, and also to try to shed some light on some of the concerns that we have in this environment. And we don't have. Let's just be honest here, people. We don't have we don't have a glass ball here for you. But what we do have is the ability to take a look back and say, what does the data provide us? Where are we at? What similarities are there? What isn't? What isn't? And then there's going to be some differences, of course, because there's always two sides of the coin. And hopefully with that, we'll just be able to bring some clarity to what you can do to either be prepared, and if you have a firm conviction on what 2024 is going to bring you, how to plant your flag in that, or if you have some possible things that you're looking at, and what to look for in those developments inside of our market or inside of the global space to take a look at this landscape and try to give you some guidance there. So with that, we are going to be jumping into this show with you. Ben, would you like to lead us off today?
Yeah, I'd be happy to. I'm really excited to talk about this show because I think one of the things that means so much to me, and I know to you guys as well, is helping people. And I think there's a lot to be had from this week and next in what we're going to cover, because there's a lot of information. I'm staring at about 50 pages of information in front of me on this desk as we're going through this stuff and digging it out, because there is just so much going on, right, guys? I mean, there's just so much going on. As we're talking about, how to adjust your portfolio, and we're going to get there, we're going to have this conversation of, hey, this is the things we think you should be looking at doing. But before you do that, you have to understand why. Like, why would we even recommend anything? Why would we be having conversations about making changes or addressing issues or how to invest and so forth? And that's because of the moving parts. And the moving parts, is one big, massive conversation. The first one is inflation. Inflation is a nasty animal, right? And the Fed thinks that it's got it under control. They think that they have, harnessed this giant, and we are going to come down into a soft landing. I am not a believer of that. I mean, I just haven't seen it happen, don't believe it's going to happen. And I think, there's a lot of information that's out of their control. As much as they pretend they're in control of this stuff, we are in a global economy. We are in a one world economy. I mean, it's scary to even say that from a biblical perspective, but we are in a one world economy. I mean, if a nuclear bomb goes off in Israel tomorrow, trust me, the stock market is going to fall. That is an absolute fact. I mean, it has nothing to do with the price of rice in Japan, but it will affect every ounce of everything that we're doing. But there's other things that affect us as well. And in the inflationary space, as we're going through it, Panama has decided that by February, they're going to cut half of the vessels that go through the Panama Canal. Now, half of the vessels, that is a massive transportation east-west. That was built because it was so hard to go around South America, right? That is the whole point, that we went through that massive infrastructure. And then we turned it over to Panama, which I think is absolutely crazy. But that being said, that is going to increase the cost of goods. It has nothing to do with anything other than Panama making a decision. But trust me, the cost of goods that go through the Panama Canal will now increase because you can only get half the number through. And then what if there's certain ships that can't get through there at all, and that they provide semiconductors for us? There's a major, major problem. And how that impacts everything else down the line is a major problem. The Red Sea, they are not transporting most stuff through the Red Sea because of all the violence and problems. That is going to affect the cost of goods. This is all inflationary impacting events that the Fed has no control over. And listening to the Fed think that they have the control is so narcissistic that they think that them just adjusting a little rate determines the price of something at our table is the biggest fallacy out there. Because there's so many moving parts to an economic culture, to what we're doing, that tomorrow, if China takes over Taiwan, trust me, the cost of computers is going up, irrelevant of what the Fed does. So I think when we think about this inflationary thing that's facing us, and the Fed is talking about that, we get into this conversation of the rate hikes and offsetting, and will the Fed lower rates? Is that really what's going to happen? There's this naive hope that the Fed's going to lower rates. But all the information I just told you says to me, well, the only thing they have to do is to raise rates again. And I've been talking about that for a while now. So Seth, I don't know how much doom and gloom you want me to dig out here, but I got more if you want.
Speaking to the Fed, I know that, what I've been reading is that they're unlikely to make another increase, before year end here, of course, but last I heard, the chairman would even consider a decrease until March, which, that's a fair amount of time to be kind of forecasting a move that may or may not happen. So, yeah, I agree with you that their ability to manipulate conditions in our economy is just overconfident. They can't quite do all that they think they can do. And I think the proof in that played out this year. It took them the full 12 months of increases to even begin to affect the rising inflation that we had. So this magic cure, or this lever that think they can switch that controls that whole entire environment, it just doesn't work the way they predict it to.
Well, if the cost of goods double again, or triple or quadruple, like some of them have, they're just going to raise rates to 20%. It's not that it hasn't happened. So right. The Fed has done this before. So for us to think naively that's not an option, to address other inflationary events. You can drive things to be so expensive that no one's buying it. But then we're talking depression, so then that's really scary.
But I think something inside of that to consider is, with the Fed's, raising rates or lowering rates, the broad Treasury sector is just keeping pace right now with the S&P. The equity market's been really strong. The rally's been strong in this last year. And so has the treasuries. And so right now it's doing what's called a risk-off signal with this. So this is a signal that says, hey, let's go ahead and get into some riskier equities like the small cap sector. I want to talk a little bit more about that small cap sector and some of the sectors of what possibly to look into. But here's the play with this Feds and the Feds either raising rates or not raising rates, and what's happened historically. So when the Fed has started to pivot, or what for us would be after raising rates, they would start to lower rates. That right there has historically been a trigger for flight to safety and a decline in that marketplace. So that's something to keep our eyes on moving forward. And as much as people would probably love to see the risk or the rates be lowered in the future, why that typically happens is because there's something endemic inside of the economy that they're trying to address, right? There's been an influx in joblessness, right? And those rates have gone up, or there's been some challenges inside of the credit markets, and maybe banks have gotten themselves in a whole nother mess of trouble or something along those lines. So that's what's happened historically for them to go ahead and try to address those issues. And with that, when they have done that, the market has pulled back as well. So those are things that I'm looking at in this next year as well. And I don't know if that's enough doom and gloom for you, Ben, but that's definitely something that I think is important to consider as well.
Yeah, I think it's not enough. Let's keep going. No, I mean, we can talk about 1,000 things, good, bad, or indifferent, and we could spin the market in a good light. We can spin it in a bad light. I think I just want to give people the worst case scenario, talk about the bad news, and then if it turns out to be better than that, well, then great, right? Be prepared for the worst, because if you are, then you're prepared for the best. And I think that's really kind of a perspective. One of the things that has to do with some of my concerns and things we've chatted about is China. China was expected to be a much bigger boost to the economy in the world globally, and it did not for the second part of this year for 2023. So that was kind of a concern. So the forecast in China is a little bit less than people had hoped it would be. There's all this hype about AI, what AI is going to do, but the truth is it really hasn't done anything. It listens through your phone, and it says an ad for 5 things you thought about for your wife or your son or daughter for Christmas, or your aunt and uncle or parents. I mean, but really, AI is it's not entirely changing the way we do business just yet. It's coming, but I would say it's literally we're at the earliest of infancy stages. If I were to compare it to a pregnancy, like you just found out you got pregnant. I mean, that's how early we are in the AI space. So, or the conversation that you want to get pregnant. We might even be there, so. And then, I mean, on top of all of the stuff we're talking about, like here we got these huge foundational conversations we'd have in any economic situation. To layer each one of those with an election coming this year just adds a whole bunch of questions to each one of those things, right? Like if Biden got back in, or if Trump becomes president, how does that affect our relationship with China right now, right? I mean, these are real questions, because either one of those can spin all of this stuff out of control. And, Trump becomes president, what happens with the Ukraine war? These are real questions that we have to figure out. Like, how is that going to impact if you have a president who's really going to embrace war? I don't know if that's Biden or Trump. I have no idea. But, Trump's one of the only presidents that we haven't had a war under. So if he doesn't embrace a war, then at that point in time, do you lay off any number of aerospace and defense companies as an investment? I mean, it's right there. We talk about this stuff all the time. I mean, we talk about this stuff all the time. So there's lots of little pieces that each one of these can be interwoven with an election on top of it.
Yeah, there's so much of the stuff, particularly the geopolitical stuff that you bring up there, Ben, that's really out of our control. It's out of the Fed's control. Those are just the things that you can't really forecast because, again, dependent upon, who gets in, or if Biden stays in, how does that affect these things? But if you look at history, kind of setting aside the personalities and the present day issues, and you just try and look at history, there's a couple things that we can kind of pick up on there. And typically the fourth year of any term, presidential term, has been a good year on the market. So history tells us that that's kind of working in our favor. We do know that whenever the market's been down, and I'm talking about the S&P 500 here, more than 18% or 18% or more in a year, which it was in 2022, then the next 2 consecutive years are up years. Statistically support the fact that 2024 could be good for us. And we entered the bull market that we're in June of 23, and so it's a relatively new bull market. And statistics tell us that the average span of a bull market is 5 years. So there are some good indicators, separate from the concern and the emotion of today's conditions, that would tell us, hey, listen, the market's going to continue moving forward here, and it could be a sustained, very successful run in our future. But then we have the kind of indicators pointing the other way that say, after sharp interest rate hikes like we've experienced, via the Fed this year, that recession almost always follows. And we keep hearing about this recession, but it just is not appearing. When is it coming?
Right, and I think that's why guys, we were talking about the news, and we were just talking how we really feel how polarized the perspectives of the market are, more so than ever before I've seen in a long time. I mean, like people are saying, low 3,000s on the S&P, and some people are saying like 6,000. I mean, right. They're not in between. There's like, and the majority of the polls, as you were pointing out in our pre-show conversation, is 80% of them seem like they're positive, like the market's going to go. But the ones that are negative, it's way worse than I've ever kind of seen it as a whole forecast kind of scenario.
Yeah,
So,
I don't think I've seen any prediction that's a single digit in either direction. They're
yesterday,
up big or down big.
Yesterday alone, I talked to two separate different clients, totally different sides of this continent. And, one was, I think we should go to cash. I think I should buy gold. Like everything I'm reading is saying we need to be prepared for the largest recession we've seen in middle of next year that you've ever heard of. And then the other client was like, I'm upset. We have too much cash. I need this money in the market. The next 2 years are going to be strong and so forth. But I believe steady as you go. I think you want to own profitable companies. You want to own companies that, are large. They're profitable. They're producing a product that people are consuming on a regular basis, and that they pay you to own them, that you're profiting from the benefit of those sales. That's where I think, the focus of a portfolio can really benefit right now in that scenario. If you're really that cautious and you say, hey, I'm not for the stock market, interest rates have never been higher in like the last 20 years for us to, go out and buy a fixed instrument that's going to pay you some sort of yield. It's not keeping up with inflation, but at least, you can get 4 or 5% until you figure this out.
5.5% of money market. That's great.
Oh yeah, I know. You get 5.5% in the money market. You say, I'll come back next year. If you guys do 15 or 20, congratulations. But I'm happy with 5.5. That's not a bad story for the right person.
All right, you guys, you're just getting too excited for me over here. I got to tone it down a little bit, bring the level down just a little bit. Folks, we're talking about moves that you can, kind of how to prepare yourself, really. How to be taking a look at what you have going on right now. Be mentally prepared, be prepared in your portfolios. Plant your flag like Ben was talking about. If you're just a go to gold person and, get out of the market and everything's, going to hell in a handbasket. Okay, we get it. We've been on those side of the coin at times as well. But the data that we have here supports a couple of different perspectives, right? And there's what we see in our purview, what we actually think is going to be happening this next year. So we're sharing some of this insight with you right now. You're listening to Money on Tap. Don't go anywhere. We'll be right back. Hey guys, Seth Cressman with Brayshaw Financial Group. Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today and start your journey towards financial independence. Brayshaw Financial Group, your partner in wealth creation.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Thanks again to our podcast subscribers. We appreciate the ratings and the feedback there. That's how you can help support us here at Money on Tap. We love bringing you this show on a weekly basis, and we love the opportunity to get that to this show out to more people. So that's how that works in the podcast world. You subscribe, you write us a little letter on what you think about the show, good or bad. It's okay. We get it. We're putting some things out there. We're not everybody's cup of tea. If we're not yours, let us know. Either way, you're helping us out, and we appreciate you for that. And we're having some fun here in the preparation that we're going through for the 2024. I love how clients have so many different perspectives. And one of the things as you were talking about, kind of the two camps, right? There's the I've got too much cash outside the market. I need to go in. I'm a risk on person. I believe this next couple of years is going to be wonderful for the market. So one camp could be that. The other could be, all I see is too much risk out there. I don't think the market's going to give us what we're looking for. And we believe that, an asset like gold is where we need to go. Cash is where we need to go. Bonds are where we need to go. Those are risk off approaches in investing typically. Now, I will say, understand gold does go up and down, right? It's traded just like everything else out there. Bonds do go up and down. Again, we've had, tremendous difficulties in bond markets, which has been a flight to safety kind of an asset. So all those things disclose, understand that before you do choose those paths. What I was more interested in what I was hearing Ben share was where people are getting their news from, because what I hear a lot of is all I hear is, all I see is. And understanding this, you're a consumer. You are grabbing information, probably not from a newspaper anymore, where you can go, oh, I know that, the Wall Street Journal is going to give me this bent. The New York Times is going to give me that. Whatever your local paper is, it has its perspective. You already kind of have that understanding. Anymore, when you're looking online for information and trying to gather how to approach whatever it is that you're looking at, there are algorithms and there is AI and there is the ability for the organizations out there to know what it is that you're looking for and send that to you, right? Because that's how it works. The more that you're paying attention to what they're sending you, the more dollars, the more of your time that they can consume. And ultimately that means dollars for them that they can translate into, a more sustainable business for themselves on feeding you that news that you want to hear. So you already have that preset already inside you. Now, trying to get outside of that, that's a real challenge. That's one of the things that we want to try to provide you here is perspective on both sides of the issues, right? You haven't heard anything from us yet that's been leaning one direction or another, unless you were listening to Ben. You know what Ben's about. But from Dan and I on the other side of this coin here, we're really all about trying to add some different value into this conversation here, which is good for you. You could be all in with what Ben has to say. We love it.
You should be. By the way, you should be.
You should be, right? Yeah. And you can certainly be here listening to Dan and myself and probably be more successful in what you're about to embark on. Either way's fine for us. But
I think we should retitle the show Fair, Balanced, and Ben.
Fair, Balanced, and Ben.
There's a...
Hey, listen. The only reason you guys are my partners is because I'm smart enough to get people who are smarter than me to join me. So,
number one rule: don't do stupid things. Okay, let's go. So with that, let's we got some stuff here for you. First of all, mutual funds, right? Mutual funds. Most people are familiar with in the investment world. It's kind of what our parents grew up with, and then there was this translation or this mutation of the market into exchange traded funds, right? And the difference primarily between those is we try to, we're not able to really give a recommendation that you have to use one or another, and we're not getting into the details on those, but there's a difference between how those especially are traded in the market and how there's different tax efficiency with those. Those are the two things that we really focus on in that, and the transparency inside of those two. And one of the things that we have challenges in is when people have non-qualified money, which is taxed every year as you have gains or losses, those are passed through to you, is people have been using non-qualified monies inside of their mutual funds. And Ben, I'd like to hand that off to you, because the translation here from how that works and how we see that expressed in our come tax time is really imperative for people to understand. And that's the big differentiator here.
Yeah, I mean, the switch to ETFs is become kind of more of a mainstay in our investing world over the last 10 years, especially as clients and kind of the general public start to realize what an ETF versus a mutual fund is. And there's benefits to both. I don't want to completely dismantle mutual funds, but in the non-qualified space or the after-tax marketplace, and when we saw a lot of this, Dan, like in the past when mutual fund companies, what they do is they'll sell a lot of their profitable underlying stocks in the mutual fund during a year when the market drops. So people would call me and be like, "Hey, listen, I people I don't even work with. I mean, I had someone call me and be like, "Hey, I just reported this huge loss a huge gain off of my mutual funds for 2008, but I lost a bunch of money. I need to sit down with somebody and go through what's going on here." And they said, "Well, that's why we don't use mutual funds." But that's more my, Dan knows me. That's my standard. I'm not a big mutual fund fan. I never have been, but they do have their place and time and so forth. But in the aftermarket space, yeah, you can find yourself with a taxable event in a year where you lost money. and it's hard to swallow.
Yeah, we actually did a full-on show about this about a year ago, I think.
Oh, yeah.
Breaking down the difference between ETFs and mutual funds. So if this part of the conversation is of interest to you, I'd certainly welcome you to check out that show. It really does kind of dive deep into the mechanics of these two different investment vehicles. But, yeah, I mean, I'd say that's my biggest issue with funds. And, when I started my career in the finance world, I was answering phones on behalf of a mutual fund company, and the fund was down like 24% that year, but they paid out like a $7 distribution per share. And so people were freaking out, because they've lost substantial amount of money, but they have this taxable gain they have to deal with.
Yeah.
So that is one of the issues with mutual funds. The other issues, that we kind of tend to have is there's so much human influence in them, right? You're paying a fund manager generally an exorbitant fee to manage these assets when, the vast majority of them don't outperform the index itself.
Right.
So, the one thing about the ETF is that it kind of, it allows you to pick a sector you believe in and just ride that rather than kind of a broader exposure to the whole market. And you kind of eliminate some of that human influence too.
Yeah, I think you also get rid of some of the areas where you're like, well, I like this general growth concept in the value space. Well, that's great, but if you say, hey, I really don't want to be in, technology right now. I think technology is way too high. Well, if you're in a mutual fund, you're going to end up owning some technology, and when that goes down, that portion of your portfolio is going to go down. But in an ETF, you can say, hey, I want to own healthcare, I want to own gold, and I want to own technology. But I want those three. I don't want anything else. Take it all else out. You can do that, and that makes you a little more limber in the marketplace when it comes to that, with diversification, with just not owning one stock or one company.
Yeah, preference-wise, it's if you, let's say you have a 401k, probably everything you have in that 401k that they're offering you is going to be inside of a mutual fund, and that's fine, right? Because there's really no tax advantage inside of that. There's, there could be some other advantages to the ETF, but for the most part, you're kind of that works. It's a tool that works inside of that. Outside of that, the taxes and the transparency or the trade to day or trade to time is certainly one of those advantages that the ETF has. Now, getting outside of those, well, how long have you been inside of that mutual fund? And can you actually establish a cost basis? That's one of the challenges that we come up with regularly, because sometimes people just have bought these mutual funds 30, 40 years ago, been holding on to them, that's very common. And so trying to establish those cost basis does have a bit of a challenge. And that's one of the things that actually, it's kind of, well, I guess I'm kind of weird like that. I like the forensics on those things, and it's fun to do. And we do that regularly. So, and then transitioning and understanding, what are your gains you're going to have as you transition? What are the taxability as you transition from an asset like that in a non-qualified into another non-qualified ETF that would hopefully provide some better diversification, or maybe it isn't the diversification. Maybe it's mostly you're looking to be inside of that sector or that part of this universe that gives you really what you're looking for, the flavor that you really want. And I like that you have the ability to really kind of pick and choose inside of the ETF. So the transition piece is important. I would just caution people just pulling triggers left and right because they think it's the thing to do. There's always going to be something that you want to be thinking down the road around that. So thinking of that, there's investing in increasing cybersecurity needs. Now, this is a space that we have believed in and understood that it's going to be so critical over the last 10 years, we've just seen so much happen with cybersecurity and the needs of that. I'm trying to think of what just came across our desk. I forget. I'm drawing a blank, but there was somebody else that had another leak in cybersecurity. And every time we turn around, if it wasn't what was the pipeline that got held up over in the Northeast there because they had an attack, right? So the companies that are investing in thwarting those perpetrators' ability to attack those digital assets is such a key place to be investing in, and that's our belief, and that's also our strategy inside of what we do at Brayshaw Financial, that we're big believers in that. So I think it's, if you're not paying attention to that, if you haven't taken a look, there's several ways to be investing in that space and kind of pulling that out of the NASDAQ is primarily where those companies would be trading.
Yeah, cybersecurity. Well, I think I don't necessarily know that cybersecurity is an investment for somebody today, or it was, a year ago or 2 years ago. But I think, Seth, you're right. I think when we look at today versus 20 years from now, the need for cybersecurity is just going to rampantly grow. And how that looks and what your time horizon is obviously has a lot of bearing on investment in that space. But understanding that space is going to be valuable, because that's really where our vulnerabilities are in a lot of the technology space. I think in reality, as you're going through your investment piece, and kind of our number, the number 3 item for us, and it just goes back and forth. It's just really embracing where your values align with what you invest in. I remember I have a client who contacted me, and I can't remember which allocation it was, guys, but we had one portfolio where we had purchased a level of hotel allocations. It was post 2021. We hadn't really ever made hotel allocations. We actually did really well in it. But we ended up buying a hotel mix in an ETF. And the client called me and said, hey, listen, I know that this hotel mix is in your thing, but inside those hotels were a number of casino hotels. I hadn't even, it hadn't processed through me that we specifically had casino hotel. Like it wasn't part of the purview. And, obviously inside the ETF, they add stocks, they take stocks away and so forth. But the current allocation had 2 different hotel allocations that had casinos in them. And so we did I appreciated that, because I'm not, it's not really in my belief that you should be gambling and so forth. So that led to pulling them out of that portfolio, removing that allocation and so forth. So, and I was fine with that, because their values, I wanted to make sure that their money aligned with their values. And we actually all agreed that, hey, listen, we didn't realize that had that allocation, and we looked for the proper exit strategy out of that. We made some money, we moved on, and I think because it didn't align necessarily with our values, and we appreciated hearing that. And I thought that was good. I mean, we're open to having conversations with people. We want to make sure that things feel good. I had clients who are very concerned about oil and gas. I sat down with them. I went through every ounce of everything that they had for total exposure on oil and gas, because when you start buying ETFs, you buy a gold ETF, right? You think, oh, it's going to own gold. It's like, no, you're going to own a gold miner, a gold refiner, a gold transporter. You know how much oil and gas you just spent right there? So, it's like people don't think of those types of things. And we went through each piece of that, and I think that was really healthy for them, because they were able to say, okay, well, we don't have an intentional target at oil and gas. We really want to focus on clean energy. And they felt good about what we had done.
Yeah, I mean, we spoke earlier about the kind of ever-expanding world of investments. So you can find yourself included in things that you weren't aware of. But, part of that expansion, and particularly these ETFs that are coming out, you can also, exclude certain things. You can really fine-tune your portfolio if you have certain beliefs that you hold near and dear, and you just simply don't want to participate in either personally or with your investments. We can tailor a portfolio to that, and you can find investments that specifically include or exclude virtually anything, particularly the gaming world. If that's something you just don't want to be invested in, there certainly are ways to do that. So I think that's one of the benefits of this expanding investment world and all the different vehicles that are out there, is you can really, really fine-tune a portfolio to match up with what you believe in.
Which I think brings us to the next one, which is just, diversification. Inside the industry, pick those options that seem to fit your needs. And I think, Dan, when we talked about ETF allocations, make that transition, get out of the mutual funds, go to the ETFs if that makes sense for you. And then you can then target a specific industry that's really relevant to what you think has value.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're navigating the financial terrain of 2024, giving you some insights and strategies to look forward to. Don't go anywhere. We'll be right back with more Money on Tap.
Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have been getting into the navigating the financial terrain of 2024, the insights and strategies that we're using, and we're wanting to share with you. For those of you out there in the radio, listening to us on the radio, we realize that maybe you're driving right now and the reception's starting to get a little bit less and less. Well, go ahead. Just pull into that Dunkin' Donuts. We know you were going to do it anyways. Grab a cup of coffee, grab your phone, and while you're having that coffee, subscribe to Money on Tap. Go onto it's you already have it. It's there. Or just search podcast on your app store and grab Money on Tap, subscribe. Now, there'll also be an option for you to go ahead and be notified when we drop a new episode. Okay, great. What you're going to do there is you're going to grab that Money on Tap and you're going to make it a practice for yourself in 2024 to increase your financial wherewithal or aptitude or just be listening and paying attention, because we're going to drop a lot of stuff. We got some great 2024 Money on Tap for you coming up that's going to help you be successful in your investing, be successful in your retirement. And we have a lot of fun doing this here. So that's, of course, that's number one, right? Make sure that you got Money on Tap at any moment that you have. Now that you've had this wonderful educational moment with us and you've got your cup of coffee and you maybe have lost the radio signal, you can go ahead and start picking up where you left off with us and make Money on Tap your 2024 go-to podcast. And with that, guess what? We're about ready to get into a wrap here. But before we do, we want to just make sure, first of all, this is a part 1 of 2 shows, so we're going to come back to this next week with more of what you're going to need in 2024, and be sharing these tips and these tricks and how to be mindful and engaging inside of your retirement or your portfolios for yourself. But with that, we want to just be mindful of the possibility of a looming recession. Okay, and this is stuff that it's 20% of what's being preached out there right now in our financial world is about recessions, and rightfully so. There's good data to support that side of the coin, and what that looks like is basically historically 8 to 9 months after a period of rapid interest rate hikes, which we've just come through, unprecedented as a matter of fact, is what those hikes have been like. It is not uncommon to hit a recession. Consumers like yourselves might be close in retirement. This is one thing that you want to be educating yourself on, is how to reduce that risk. Okay. When we don't necessarily say go plant your flag in buying gold, there's a lot of other ways to try to reduce that risk and stay invested, though, because that is a key. It is a key here that you need to be invested.
Yeah. I think the looming recession thing is a very scary fact. So we've talked about a lot of different stuff going on. And if you're not prepared for a recession, if you're not aware that could be right around the corner, you'd be naive knowing all the historical data, which is why a lot of these people have this doom and gloom. But at the same time, there's all these other things that are saying, hey, the market's ready to run. And the $14 trillion that was printed, Dan, I mean, that's a lot of money to help the market run with. So, maybe a diversification in a savings account with rates being where they're at today. Maybe that's part of an allocation. Maybe that is something you're doing. Make sure you're not cash strapped from a standpoint of you can't accomplish what you need at any given time in an emergency, should that occur, and you're now dependent on an economy that is now facing a recession.
That's going to do it for today on Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'll be back next week with more for you to be successful in your investing. Thanks for being here with us today. Can't wait to be here with you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.